Real estate investment trusts have performed incredibly well over the past year, earning investors a 40% average return in a single year. But if you look at the chart that I just put on the screen, you'll see that REITs also suffered a little dip in recent weeks, as most of them dropped by about 5%. But note that this is just the average of the sector. There are many individual REITs that dropped a lot more than that, in many cases by 10 to 20%, and as a result they've become opportunistic once again. Hey everyone, this is Jussi. I run a small investment firm that specializes in REIT investing. In today's video, I'm going to discuss 3 of my favorite REIT buy the dip opportunities in today's marketplace. But before I get into it, I want to let you know that I plan to soon interview several REIT management teams for my REIT newsletter, High Yield Landlord. This includes Gladstone Commercial, Agri Realty. We recently already posted the interview of Vici Properties. These are completely free. If you want to access them, make sure to check the first link in the description of this video. Sign up so you don't miss these interviews. Again, they are free as part of the free tier of my REIT newsletter. So the first company I'm going to discuss here is called BSR REIT. Its ticker symbol is HOM.U in Canada, where it's primarily listed, and BSRTF in the US. And I think that this is a great buy the dip opportunity. It rose earlier this year all the way to $14 and some cents. Now it has come down about 10%. It's all again in the high $12. And this is resulting in a roughly 30% discount to its net asset value. But I think that this discount will be short-lived because the company has several catalysts now to unlock value for shareholders in the near term. The first one applies to all REITs, but especially so to BSR. Interest rates are going to lower levels. This should benefit BSR especially because it has a bit more leverage than the average REIT. The Fed already cut interest rates by 50 basis points, expected to cut it by another 25 basis points in the near term in November, I think November 7th. And then going forward, it's expected to cut it again several times by 25 basis points. The debt market is today predicting interest rates to drop to the low 3s. And at their peak, they were in the mid 5s. So this is a very significant drop, and this should lead to higher property values for BSR. I think that cap rates will compress for apartment communities, especially those owned by BSR, which are mostly in rapidly growing Texan markets, which are in high demand among institutional investors. Today, they are valuing their properties with a cap rate in the low 5s. I think that cap rates are going to compress to the mid 4s, perhaps even low 4s in some cases. So there's significant upside in its NAV, and so a discount of 30% just doesn't make any sense in my opinion. REITs tend to be priced at a discount if the NAV is expected to drop, but in this case, I expect the NAV to rise, and I think that as this becomes clear to the market, it will reprice it much closer to its NAV. Then there is a second catalyst that's quite important as well, is that I think that right as interest rates are cut and cap rates compress, I also expect rent growth to accelerate. And that's because new supply is going to dry up quite significantly in 2025, 2026 compared to the recent years, which were characterized by significant supply and even oversupply in many regions, including Texas, which led to slower rent growth. Now we're going to see a dry up of this new supply because the surge in interest rates, the high inflation put most new construction projects on halt. So there's going to be a less supply growth going forward, but the demand growth will still be there in these rapidly growing Texan markets. So this will lead to a more favorable supply-demand environment, faster same property NOI growth for BSR, as well as to its peers like Camden Property Trust and Mid-America Apartment Communities and others. But I like BSR specifically because its assets are all located, or most are located, in rapidly growing Texan markets. To be more specific, the Texan triangle of Dallas, Houston, and Austin. These are expected to be some of the fastest growing cities over the coming decade, and I think that this positions BSR especially well to capture significant rent growth. And then the third catalyst here has to do with the capital allocation of the REIT. BSR, in my opinion, is very well managed. The management is very friendly with shareholders. They are themselves major shareholders of the company. They own significant stock, and so they're doing what's best for the shareholders. And in recent years, they've been very actively buying back shares in very significant volume. They keep doing that today, but on top of that, we also expect to see significant dividend hikes. And just recently, they already hiked it by 7%, but we think that we'll see more of that. And just recently, one of our analysts, Samuel Smith, had the chance to talk with the management of the company, and here's what they had to say about their dividend.
Hey everyone, this is Samuel Smith here. I recently spoke with BSR REIT's CEO and CFO and was able to ask them some pretty pointed questions about their company. One of the biggest takeaways from the interview, though, was that management spoke about how their payout ratio has recently come down. The board typically targets a low 60% payout ratio, which is pretty similar to what some of their industry peers do, or even some of their industry peers even have a higher payout ratio, say in the 70%. But theirs has now fallen out to the low 50%. It's probably around 53%. And that's due to buybacks. It's due to some organic growth. It's due to them paying down debt and reducing interest expense. And so for all those reasons, their payout ratio has come down quite a bit. And so they have significant flexibility as a board. He implied they're going to be revisiting their dividend payout policy, which likely means that they could be growing their dividend moving forward. And this could be a huge catalyst for the stock. It currently trades at nearly 30% discount to its net asset value, whereas most of their peers trade at low single-digit discounts to NAV, or even on par, or even at a premium to NAV. So there's a huge potential upside here for the REIT. And I think one of the catalysts that could unlock it in the near future is additional dividend growth. There are several other catalysts that he mentioned in that interview. And so I encourage you to come check out my video that I just posted that discusses these. Hope to see you over there. Thank you very much.
And so to recap here, lower interest rates, faster rent growth, lower cap rates, so higher net asset value, more buybacks, greater dividend growth. All of that combined together, I think, is a powerful catalyst that should help the market sentiment of the company. And yet it's still discounted, especially following the recent dip. And for this reason, I'm happy to buy the dip and accumulate more shares of the company. Before I move on to the next REIT, make sure to check out the YouTube channel of our analyst Samuel Smith. It will be the second link in the description of this video. There we cover all my favorite non-REIT investment opportunities for the most part. Sometimes we also cover some REITs, but mostly we cover MLPs, BDCs, closed-end funds, and other high-yielding vehicles. Really, it's a lot of high-quality content that's completely free, so make sure to check it out. Then the second REIT I'm going to discuss now is called Sun Communities, ticker symbol SUI. This is the leading REIT that specializes in manufactured housing communities as well as RV parks and marinas. These are some of the best real estate assets to own for the long run because they consistently enjoy some of the best supply-demand dynamics that result in consistent, strong rent growth and asset value appreciation. But recently the company suffered a little dip. Its share price dropped by about 12%. I think that there are two main reasons for it. Firstly, a short report came out, and secondly, the market seems to be a bit concerned about the potential impact of Hurricane Milton. As a result of the recent dip, if we now zoom out the recent chart, you'll see that Sun Community is still priced at a roughly 38% discount to its recent peak of 2021, which shows you that it's pretty significantly discounted, but it's actually even cheaper than that when you adjust for the fact that the company has grown its FFO per share by about 12% since then. So with this growth and the lower share price, it's actually about 50% cheaper than it was at its peak. This also means that getting just halfway to its previous peak could unlock up to 50% upside from here, and this is why I like the story. So what about this short report? Let's discuss that first. Well, they make some interesting points. I think that for the most part, the fears are not really warranted here. They allege that the CEO is lacking credibility because it had taken a $4 million loan from a related party, and then they point out some other suspicious past behavior that has little to do with the REIT itself. However, if they're trying to allege that the company is poorly managed or not friendly to shareholders, it's pretty easy to argue against that by simply looking at the long-term performance of the REIT. I'll put a chart on the screen. You'll see how Sun Communities has performed relative to the S&P 500, and you'll see that it has actually been one of the best performing REITs of all time. So it's hard to argue that the REIT is poorly managed. Secondly, the short sellers also argue that the company might be understating their capex, and while they are making some interesting points, for the most part I think that this can be debunked quite easily because they are comparing the capex of Sun Communities to some apartment REITs like Camden Properties Trust, and this just doesn't make any sense because they don't own apartment communities. Yes, both are residential properties, but it's very different in terms of capex because when you own a manufactured housing community, typically the landlord doesn't own the homes themselves. They only own the park, so the land with the associated infrastructure, and then the tenants bring on their own manufactured home. They rent the lot from the park owner, which is Sun Communities, and so understandably the capex is going to be a lot lower because the maintenance of the home itself is the responsibility of the tenant. Sun Communities only needs to maintain the park, the infrastructure, the facilities, whereas when you compare that to an apartment landlord like Camden, they actually have to take care of the entire building, the units, all the turnover in tenants, and naturally this is going to lead to higher capex. And so I'm not particularly worried about this argument. And so what about then the Hurricane Milton? Is this a bigger concern? And there might be an impact, but so far what the REIT has told us is that they expect very minimal impact. Here's what they said in a recent press release. The company has access to all of its properties and assessments are still in early stages. Cleanup and restoration efforts are underway at all affected communities and marinas. At this time, we do not expect hurricane to have significant impact on our operating results and financial conditions. And so this is rather reassuring in my opinion. And again, this doesn't mean that there won't be any impact. There might be near-term impact that will be negative, but I'm a long-term real estate investor, and so, I understand that the value of these properties should be based on decades of expected future cash flow, not the next quarter or even the next year. That should have a very minimal impact on the valuation. And so the recent drop in its share price of 12%, in my opinion, is a great buying opportunity, especially considering that the valuation of the company was already discounted quite heavily prior to that. Right now, the shares are trading at 17.5 times FFO. We estimate the fair value of this company at closer to 25 times FFO. This implies that there is about 30 to 40% upside in from here. And I think that this is a great risk to reward proposal, given that it's focusing on some of the most defensive real estate assets in the entire commercial real estate market. Hey, before I go into the third REIT of this list, can you please do me a huge favor and click the like button if you think that this content is valuable? That will help me a lot to keep on growing. Thanks so much in advance. So the third buy the dip opportunity on which I recently acted is called Armada Hoffler Properties, ticker symbol AHH, and this is a small cap REIT that focuses mainly on mixed use properties that combine retail, residential and office under one roof. This is a unique asset class that's often misunderstood by the market, and I think that this is really the reason why the REIT is priced at such a low valuation. It sees that it has high exposure to office, and it's with about 30% of its income coming from it, and it assumes that it's going to face significant troubles. But I think that mixed-use properties are truly unique and a market in itself. These properties have many unique advantages because there are synergies between the different uses. It makes it very convenient for the resident of the apartment or the office tenant, or even there are also synergies for the retail businesses because they all combine together. The property is walkable, makes it more desirable. Again, a very significant convenience factor. Typically, these properties are also located in some of the best locations in their individual markets, and so this explains why the REIT enjoys some of the best performance in its operating metrics. And this even applies to its office space. It's enjoying growing rents, high occupancy rates, very strong tenants, no delinquencies whatsoever. The same applies also to its retail, to its residential. And so ultimately, I think that these are Class A properties that are very desirable, that will perform really well over the long run. But the shares of the company recently suffered a dip. They dropped by about 10% after the company announced that they will raise some additional equity capital. As a result of this dip, the company has now mostly missed out on the recent rally of the REIT sector, and as a result has become heavily discounted relative to most other REITs. And I think that this is an opportunity because, yes, the capital raise is likely to be a bit dilutive to its FFO per share over the short term, but according to our calculations, as they put this capital to work in new development projects and some debt paydowns, it shouldn't have a material impact to its FFO per share. Therefore, we view this dip as a buying opportunity. Right now, the shares are priced at less than 9 times its FFO. It's offering a 7.5% dividend yield. And this is ultimately the lowest valuation, the highest yield that you can find in today's market for a REIT that owns Class A properties. Our fair value estimate is about 50% higher, and this is why we are buying shares. We have in the past already interviewed the management of the company. If you want to access that interview, it's available at High Yield Landlord. So make sure to go sign up for it. Again, completely free. I removed the paywall for it for the next few days. I'll put even the link to the interview so you can check it out in the description. Otherwise, as I've said before, you can also access my full portfolio by joining the paid tier of our REIT newsletter. There's a 2-week free trial, so we'll give you immediate access to all my portfolio, all my transactions in real time. You won't be charged anything in the first 14 days. Finally, if you could please click the like button if you thought that this was valuable, that will help me a lot. Thanks so much for your support. See you at my next one. Bye-bye.